You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, good morning, Jim. If we're talking on the phone, it must be Friday.
And we're wondering, can anybody fix the markets? The central bankers always think they can, right?
Oh, yeah. It goes right back to the start of the Federal Reserve. The guys who were promoting it said that, and as anybody with any experience knew at the time, that if you get a very sharp market setback in the financial market, it'd be followed by a recession. So they came up with the brilliant idea that, well, we will prevent financial setbacks, therefore there won't be any recession. There's been 19 recessions since. Some major crashes, one depression, and we could be in the early stages of another depression here. So, I don't know why the academic community doesn't take this line of criticism. Look at what they say, look at the result, and here we are. So, the Bank of China in April was encouraging people to do some new issues in order to satisfy buying demand, and then in the panic they discouraged people from doing new issues. Not that you can do new issues in a panic anyway. So it's all a fraud. The amazing thing is that it's gone on for so long. This idea that you can get some guys with a PhD in economics, appoint them to the Federal Reserve or the Bank of Canada or other central bank, and they immediately become more brilliant than they were. The title of being governor of the Bank of Canada or chairman of the Fed confers something special. I think it's a form of artificial intelligence when you just take a run-of-the-mill PhD, put them as chair of the Fed, and immediately they're brilliant. But the track record is not brilliant. So here the question, and what we're wondering about, is can they prevent a further contraction? And of course, our view is that they can't, because in order to prevent a contraction, they should have prevented the bubble. But anyway, so all of the policy stimulus, QEs and everything else, conspired to add to the bubble. So no, I don't think there's any way out of it. And but you also see that by the end of June, it was seen that the Shanghai market was getting hit pretty hard. So then came out the spokesman and say, well, it's isolated. Won't bother the U.S. There's good values here. So, of course, that's all being taken apart. But what we wrote yesterday was that it's the credit spreads. In the good times, they narrow, and when they reverse to widening, that puts up a warning. And for this year, we wanted to have the spreads that would be between U.S. BBB bonds and Treasuries. We wanted to have those break out on the chart in early July, which they did. And then the next one would be a more serious breakout in spreads late July, early August. Well, it turned out to be early August. And then you want it to move dramatically, and that coincided with the big washout. So it did nothing with it. But if we go back to the last bubble in 2007, the credit spread started to turn in that June, and you had the first failure, which was Bear Stearns. People kind of think that the whole disaster was later on in 2008 with Lehman. But it was Bear Stearns getting in trouble. And I would suggest that the central banks there really cracked open the taps on money injection into the system, and they did not turn off the taps. They kept doing it, but you went through, and the Dow sold off something like 48% anyway by the time you get to the bottom of that pair. And so here we are. We've got the same relentless widening of credit spreads on now, and it did become dramatic a few weeks ago, and that was part of the sell-off. Now, you had the first hit down to what they called a Black Monday, August 24th, fell very, that was, get me out of here kind of market. And that was also coordinated with very weak commodity prices. Of course, as I said, the widening credit spread, junk bonds heading down. And so it was, classic stuff. And then that phase, it sort of exhausted itself. And then you've had a couple of relief rallies there. But if you look at the S&P, the first bounce was quite vigorous, then corrected, and then the most recent rally to a few days ago did not reach a higher high. That's rather important. The other one that you expect was the volatility, which had gone to sleep, and it was enough, that you had what they called the Great Recession. It ended in 2009. Then we finally got up to elevated stock prices for a long time. I've called it the Great Complacency. And then suddenly there's no complacency, and the VIX measure of volatility, it needed to break above 20, and it did that before, as the whole thing was happening. It shot up to 53 or something like that. So anyways, we've got the recipe for a serious contraction, and with the rebounds, whether it was in crude, commodities, other commodities, or junk bonds, or the stock market, you had the first rebound to a certain height, and the second rebound not as high. So this looks like, and then technically we've got a couple of sell signals on the S&P now. So it's going to head down. Now here's the other point, is that typically major financial problems and embarrassments and defaults and whatnot are traditionally found in the fall of the year. And that goes way back in history. For some reason or other, if it's going to fall apart, it'll fall apart and get exciting going into late September, early October. So this looks inevitable. The other thing was to mention, Jim, is that the Bank of China and policymakers in China were absolutely very busy in trying to stem the crash. They halted trading on big issues. They stopped the issuance of new issues. Pulled everything else, and they went around blaming certain journalists for causing the crash. They're paranoid over there, and it'll get worse. So, yeah, I hate to be a wet blanket, but you have to look at the excesses that were accomplished as the market was topping. You have to look at the sharpness of the break and the technicals on it. It's ready to get weaker.
We'll have more with Bob Hoye right after this.
Unbelievable harmonies, spectacular performance, Bird Dog and the Vintage Electric Band, the ultimate tribute to the Everly Brothers and Simon and Garfunkel. In Oliver, October 2nd. In Kelowna, October 3rd. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with market historian Bob Hoye. Bob, I hate to get political, but our Prime Minister just said if there's a recession, it won't be like 2008. It won't be that bad. It'll be recession light. Other people have told me the way this is setting up, it's sort of like 1929, and it took us 24 years to crawl out of that. What kind of a downturn are we looking at?
Well, the 2008 disaster, the 2007 bubble, 2007 one, had much of the features of the 1929 bubble, or the one before that, 1873, like terrific. You had some commodities with it, you had real estate, you had everything. And that crash was, I think in the S&P, 48%, while if you looked at in 1930, London was the senior index, and it kind of fell in half, whereas with the 1929 crash, the S&P fell to, gave up 85% or something like that, but then it was a more junior exchange. Now it's one of the senior exchanges. So, yeah, and then you've had the first bull market and the first business expansion out of a classic crash. And even listening to the establishment, they said, yes, that was the worst financial collapse since the 1930s. So then you've had now an unbelievably vigorous bull market, probably greater than you got up to 1937. And this time, on top of that, you had the Chinese market become absolutely insane. So it has done, it did the same thing in 2007 as it's done recently, even with the technicals like our upside exhaustion readings. On China, we needed one more set of upside exhaustion readings in June to complete the move. Well, we got one upside exhaustion, which was enough to end the move. So, yeah, we're going into another serious contraction. And these contractions will go on until all of the abuse of the credit systems end. And that abuse is not done just by private individuals, but governments have been in on it. In the U.S., you got counties and municipal governments that are absolutely reckless in their budgeting, right out of control. So there's going to be a whole lot of excesses washed out of the market. And I think there's nothing anybody can do about it. As a matter of fact, I think what it's going to release is a new bull market for common sense amongst the public. They're going to take a look at what central bankers have been saying, all their promises, and all the money that they've spent on these QEs, quantitative easing. What a lot of nonsense. But that's all taxpayers' money. So these guys have been allowed to run an experiment in promotion backed up by the taxpayer. And the taxpayer is going to look at it and say, hey, this is not working. We will move to constrain or eliminate or sidetrack your ridiculous theories. So I think the market's going to get bad enough that it's going to change the concept of hands-on management of the economy. So it's going to be a very exciting time. So in answer to the question, yeah, we're going to get a very serious contraction.
So what about commodities like gold, oil?
Yeah.
Is crude going to just continue to fall?
Well, if we go back a year and a half ago when that rally out to about 105, and that's when we looked at what was going on in other commodities in the credit markets, and that's where we decided that crude in the last great contraction, if you measured in gold terms, it fell to a quarter of its high in gold terms. So, and then it was around 100, we then said, well, let's just come up with a ballpark figure. Crude's going to fall to $25. We still think that. And that's, in previous contractions on the agricultural side, that each year, now say given no disasters in the crop or weather or like that, so each year the farmer gets less money for his grain. So what happens? He grows more each season in order to get more money. So in the commodity side, it's called, planting from fence post to fence post. So you're getting the same thing now in crude oil, where the fracking guys are developing new techniques to try and make the whole thing profitable. So the contraction in a post-bubble contraction, the condition is that the senior currency becomes chronically strong against most currencies most of the time, and again strong against most commodities most of the time, and no amount of inflationary efforts can overwhelm it. So this is where I think sensible people will look at this recent experiment where their ease credit stimulation, in particular, let's use the U.S. as the example, was to have an economic boom. But post-bubble contractions, you can't have economic booms. You can have an economic recovery on the business cycle. So all of the excess stimulation went into financial assets, and that's the part that's getting burned out. But, I just saw a study the other day. For the last 3 years, the Fed forecast for the start of each year, like in January, was for 4% GDP growth. And by the end of the year, it was sort of like 2%. And they did it at least 3 years in a row. So they don't even know what's going on. But that shows that their assumption that with the stimulus that they were doing, they should have got 4% GDP. But that's in their models, which have nothing to do with reality. So, unfortunately, it's going to be very unpleasant. But if you want to look to the brighter side, the folks' common sense will overwhelm the nonsense that a committee of people with PhDs can manage an economy. It's been absolutely absurd since day one anyway.
So where should we be putting our money?
Okay, well, when the junk bonds, which were showing great returns, peaked out in June a year ago, we advised getting out of all risky products and then owning 3 to 4 year U.S. high-grade bonds. You don't get the yield that you get out of junk, but then you won't get the price whack hit. And then you also would get the pickup in the U.S. dollar. So that's been a very good position. We didn't suggest buying gold because the whole gold sector has been in a bear market. But the advice on gold is that one should own a little in your safety deposit box, just kind of like an insurance thing. But like insurance, for a household or your life, you don't expect to make money out of it. It's just there. So,
well, Bob, we had a question from one of our listeners asking about gold, why gold mining stocks are affected by the financial markets. Well,
there we are. In 1929, gold mining stocks crashed with the market. In 2007, they did, and they've been weak here. So, yes, gold becomes the counter item, like that moves opposite. But you still have the thing that the gold stocks are listed on the exchange, and when you get the utilities and the bank stocks, all being sold out, well, they'll sell their gold stocks too. So this is where we're heading for a very good re-entry into the gold sector, but not yet.
Bob, have a great weekend.
Very good then, Jim. Always good to be with you.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter, Talk Digital Net. Our YouTube channel is Talk Digital Network. You can forward questions for the show to info@HowStreet.com. I'm Jim Godley.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.